It's a real pleasure to welcome you all to the Mondo Visione Exchange Forum 2011. And thank you all for coming, and thank you, Herbie, for asking me to give this morning's opening talk. I believe that this conference is actually very well timed, with an extremely important agenda, given that we are facing an especially critical and highly uncertain time for global markets. And if it's an uncertain time for the markets, then it is an uncertain time for every one of us in this room. Because we're all faced with the question of how to deal with the changes that we face ahead and how to turn potential risk into opportunity. So in times like this, we look at our legacy businesses perhaps and we start to wonder how to grow them. Perhaps we start to think about adjacencies to the current role our businesses play in the market structure. So for example, if I'm running an exchange, do I merge with another exchange in response to what other competition is doing? Do I presume regulation of the OTC markets towards central clearing means I should buy a clearinghouse? Or do I start to generate new revenue from selling premium market data or renting, hosting and co-location space? Or even should I start to sell technology? Often these moves prove difficult to pull off. Obstacles arise that prevent intended progress, especially in the context of the waves of regulation and self-interest that are emerging in the demands of investors for more, for less, and the startup competition that shows up and can apparently take market share at will. Perhaps it would be easier and more fun, especially if you're running the London Stock Exchange, to run a vineyard in the Rhone Valley. Now, Xavier actually does that, but in Xavier's case, his determination to do the right thing keeps him engaged and keeps him pressing on. And that's what I'm going to talk about today. We must all press on together in the face of real financial uncertainty. We all have a shared responsibility to make these markets work really well. So context always matters. While we face an uncertain future, we can say that waves of regulation will indeed kick in. From Dodd-Frank, from MiFID II, Basel II and III, and EMIR, this will indeed lead to fundamental change for all of us. It certainly means an overhaul of the OTC derivatives trading markets, the shift to centralized clearing and how margin is treated. The regulations introduce a reporting obligation for OTC derivatives, a clearing obligation for eligible OTC derivatives, and measures to reduce counterparty and credit risk and operational risk for bilaterally cleared OTC securities. It sets common rules for central counterparties and for trade repositories, and defines rules for the establishment of interoperability between CCPs. And the European Commission stated that all standardized OTC derivative contracts should be traded on exchanges or electronic trading platforms where appropriate, and cleared through central counterparties by the end of 2012 at the latest. So OTC derivative contracts should be now reported to all trade repositories. Non-centrally cleared contracts should be subject to higher capital requirements. So, what does all that mean? Now, if you're an interdealer broker and you happen to operate an electronic platform for swaps, perhaps your role as a true CEF has been formally validated. For banks, the capital requirements mean certainly less profit, which means that apart from having to find ways to comply with inbound regulation and reporting, the single largest priority financial institutions face today is to drive out expense to protect operating income. Expense reduction requires immediate investment in more streamlined processes, more business automation, and more effective systems to manage risk and provide adequate surveillance, and better connectivity to content, applications, and sources of liquidity. In the exchange arena, we'll likely see growing interoperability leading to liquidity consolidation, either through mergers, although those are proving difficult to pull off, or consolidation through alliances, virtual connections between partnering venues, all of which requires, again, even more efficient connectivity and transparency. In our own business, our Electron initiative is seeing a significant influx of customers, prime brokers and venues, seeking to efficiently cross-connect to liquidity and even faster, deeper, and relevant content. But perhaps if we stand back from all of these impacts, what does all of this enforced change mean actually for real trading liquidity. This brings me just to three words that I'm going to consider this morning: connectivity, transparency, and liquidity. Now, it strikes me as a little strange. We use these words all the time, but perhaps it's interesting to stop to think what we mean by them: connectivity, transparency, and liquidity. We probably think they're all really good things. We may also think that they're absolutes. But really, we must talk about degrees of connectivity and degrees of transparency. Perhaps there are limitations to liquidity. Does greater connectivity and transparency necessarily lead to greater liquidity? For without solid liquidity, all the mechanisms, regulations, and facilities are actually for naught. With greater interconnectivity and speed in global financial markets, as well as any complex system, we may in fact get more randomness and uncertainty. And when things become more fragile and uncertain, we're starting to use words that investors, regulators, and the markets themselves just don't like. With ever more sophisticated trading strategies involving many more trading firms, multiple venues, and intertwined asset classes, we're seeing constant growth in demand for connectivity. And pools in the BRIC countries and Asia begin to cross-trade with new alliances such as those between the Asian exchanges, BM&F, Bovespa of Brazil, the National Stock Exchange of India and the Bombay Stock Exchange, Johannesburg Stock Exchange, MICEX, RTS in Russia, and so on, all creating aggregate substance from smaller markets and attracting order flow across borders. From an investor perspective, it may become more and more difficult to understand what is really going on. How do they keep track of the real liquidity and the true cost of execution? Now, let me say, for some people, this complexity is a really good thing. There are plenty of hedge funds and investment banks that make a living from taking a different view of the maturity of alpha from others. They analyze complex information to gain a better understanding of what is going on. They can arbitrage between their understanding and the market. For them, complexity, so therefore, can be a really good thing. They can work the market systems, both exchange-based and OTC liquidity, without showing their hand, perhaps best illustrated by the growing use of algo scaling, artificial intelligence, and machine-driven strategy plays. But financial markets, particularly outside the exchange-traded world and at the boundaries between OTC markets, are increasingly complex, and that creates special problems of transparency. What we have is a case of information asymmetry. Some people know, others don't. As Michael Spence put it, as the complexity of the system increases, gaps and asymmetries in terms of information, knowledge, and expertise are multiplying. Such asymmetries impair market performance in a variety of ways, and conflicts of interest are particularly dangerous as such an environment because they create an incentive to exploit precisely these advantages. In other words, information asymmetry is a good thing if you know and no one else does, a bad thing if everyone is flying blind, as arguably some participants are right now. So this raises important questions about level playing fields. True, connectivity and transparency can begin to break this down, but in fact asymmetry is part of the diversity, and so the undoubted strength of the markets themselves. It's not all a bad thing. OTC markets function because they're flexible and can create novelty. They can adapt. If everyone had the same information and traded in the same way, what sort of markets would we have? We have to have levels of differentiation for markets to flourish, as clearly too much certainty would be as bad as too much uncertainty. Ultimately, only more and better information and machine intelligence can help keep market access level and satisfy the public, politicians, and regulators, in part because only machines can keep pace with market dynamics and flows. So the background to all of this is the essential relationship between information transparency and liquidity. As a company, Thomson Reuters and others strive to aggregate content and connectivity to create an open market fabric in which to trade with confidence. But the grand challenge to anyone concerned with markets is how to translate connectivity and transparency into liquidity. And since liquidity has a lot to do with solvency, translated into greater economic and financial well-being, if not system-wide stability. That seems to me to be the goal of political leaders, regulators, exchanges, and just about anyone else involved in the financial markets. So as I see it, delivering more and better information is crucial if we're to make the balance between connectivity, transparency, and improvements in liquidity, because it opens up whole new possibilities. One way of looking at the importance of information is to relate it to uncertainty and risk. If we follow Knight's view of uncertainty, the simple formula is that more information, less uncertainty. Yet he also talks about what we now tend to call unknown unknowns, or black swans. But however we see it, this is not about passive information. Given the increasing complexity and volatility of the markets, we're in a race to produce analytics that makes sense of what's going on, mapping emerging new relationships across and between individual markets, aggregating and integrating content in new ways, and providing new models to create market intelligence. Information is not passive, though, in another way. There is an important distinction between pre-trade and post-trade. We've come a very long way in reporting what has happened, but we have a long way to go on what might happen. So why do we call this a grand challenge? Well, let's think about it. At any moment, buyers and sellers have orders looking for prices and execution. Yet those orders may be complex in multiple asset classes, sequenced and dependent on, say, a chain of execution events. They may depend on the intentions and feedback of other buyers and sellers in multiple systems, and they might be routed to both OTC and exchange markets. Our buyers and sellers are, of course, connected to our screens, feeds, messaging systems, trade management, and execution systems across any number of venues. And we're providing this sort of connectivity already. But now we see that the market is growing for what some observers are calling multi-asset trading integration. And there are many different ways of seeing this, but one way or another, the ability to see portfolios across different asset classes is likely to become ever more important. And this is why we're rapidly providing more and more connections between investors, markets, and a whole new group of participants around the world. Peer-to-peer connections are certainly on the short-term horizon, as well as a growing number of large-scale, highly networked hubs, including exchanges, exchange alliances, MTFs, brokers, clearinghouses, and so on. All of this increases the depth of information, and so, therefore, the potential depth and potential for increased liquidity. But there is one more step. While everyone may become connected, many can only ever see a fraction of the possible. Let's say the latent trades behind the picture. They have a trading strategy, and the right liquidity is out there somewhere. They just need to find the best trade and the right counterparty at the right cost. Increasingly, complex trades must be executed in rapid sequence without legging risk where one failed trade might break the sequence. So perhaps our next frontier is actually a true optimization of liquidity itself. So I believe as an industry, and for all of us in this room, we have a long opportunity for innovation and collaboration ahead of us. The grand challenge is not only to deliver more and better information to reduce uncertainty, but how to generate new forms of efficient and market-building liquidity for the benefit of all. And so this Mondo Visione conference gives a platform for you to debate more eloquently than me, I'm sure, the inbound changes facing market structure, and in a more regulated, debt-constrained world, how we can all respond effectively together. These responses will help us come together as an industry, an industry-led union, if you like, that will help shape and improve the future of the world's markets. And I, for one, believe this is a truly exciting prospect, and I wish you a very good and positive conversation about that subject over the next few hours.